Hey, what's up, my friend? So, in today's episode, I'll be sharing with you, right, simple tweaks that you can make to your trading and get results fast. Okay, so these are simple, actionable techniques that you can use, right, and you should expect to see, results with it, right, in a short period of time. So, number one, the first thing that you can do is to trade from an area of value. Now, what do I mean by this? Well, let's say the market is in an uptrend, right? Where is an area of value in an uptrend? Well, it could be at support. It could be at a respected moving average, right? These are all possible areas of value in an uptrend. Likewise, in a downtrend, okay? Just because the market is in a downtrend doesn't mean you look to sell immediately. Let the price come to an area of value. Resistance, swing high, moving average, trend channels, these are area of value that you want to trade from. Okay, and I know this sounds simple, but why don't traders do it? I'll tell you why. Because they don't have patience. They just want to trade right now. They want to action right now. They don't want to wait. They don't want to sit on their hands. And that's why, they lose consistently. Right? So number one, trade from an area of value. Number two, trade with the trend. Trade with the trend. Why do you want to fight against the trend? The trend is your friend. You've heard this probably a gazillion times. And again, why do traders want to trade against the trend? I'll tell you why. It's because they think that the market can't go any higher. Oh, look, Rayner, how bullish this market is. It's too high. It can't go any higher. And then poof, next day it goes up another 100 pips, 200 pips the next day, and so on and so forth. Well, again, really, if the market has been moving up steadily higher over the last 3 months, then the common sense thing to do is to expect it to continue moving higher. But most traders, they want to fight it. They think that, oh, it's too high, it can't go any higher, and they fight against the trend. They lose money. So really, keep things simple. Okay, let me share with you a very simple guideline. If you can't define the trend, then just pull out the 200 period moving average. Whichever time frame you're on, the daily, the 5 minutes, the 1 hour. If the price is above the 200 period moving average, then you only look for buying opportunities. You won't even consider selling. Okay? And likewise, if the price is below the 200 period moving average, then you only look for selling opportunities. Don't consider buying. Now, of course, this is not foolproof, but it should keep you on the right side of the trend more often than not. So this is just a very simple guideline for those of you who are struggling, right, to define the trend. And number three, have a proper stop loss, right? You can't just put on a trade and put in a random 35 pip stop loss because that's a nice number, because that's how much money that's left in your account, yada yada. It doesn't make sense. The market doesn't care how much money is left in your account. All right, it goes where it wants to go, and you got to respect the market. So 35 pips might be reasonable for someone trading off maybe the 15 minutes time frame, but if you trade off the daily time frame, that's too little. You'll likely get stopped out just on the the noise of the markets. So how do you set a proper stop loss? Okay, so there are a few ways to it, but I'll share with you the simplest one. Whichever time frame that you're looking at, okay, all right, look at the nearest price structure. So let me give you an example. Let's say you bought in an uptrend, okay? Ask yourself, where is the nearest price structure, like a swing low, like support? Where is the nearest one? Then set your stop loss below it. Why? Because this price structure will act as a barrier to help you hold up the higher prices. So if the price makes a pullback, at least this area of support could provide some obstacle, right, for the price to have difficulty breaking below it. So you're actually setting your stop loss, right? You're using the natural price structure of the market, right, to make it difficult for it to reach your stop loss. So if it's in an uptrend, set your stop loss, let's say, a distance below the swing low, a distance below support. If it's in a downtrend, set your stop loss a distance above resistance, a distance above the swing high, right? Make the market work hard, right, to reach your stop loss. Don't set it at a random, 5, 10, 20 pips based on how you feel or how much money is left in your account. Doesn't make sense, okay? Number 4, have a target that makes sense. So stop loss is fixed. What about targets? Let's say you're a swing trader. Do you just randomly set a 50 pip target because it's a nice number? Or 75 pips because you like the number 7 and 5? No, of course not. Again, as a swing trader, or as for most discretionary traders, your target is usually at a level on the chart, right, where the market might turn against you. Let's say you bought at support. Where do you think the market will turn against you? Well, if it reaches support and it starts to hit higher and it approaches resistance, that's a area on the chart where the price could turn against you. So as a swing trader, what you want to do is to exit your trade before resistance, to exit your trade before the market reverses against you. The last thing you want to do is to set your targets above resistance or to have a random 200-300 pips a target, which doesn't make sense. Again, right? Have a target that actually makes sense. That's number 4. And finally, number 5, have a trading journal. I know this sounds, Rayner, not this again, but this is so important. Because when you have a trading journal, you can record down your trades. You know which trading setups are the ones that are making you money. Is it your breakout trades? Is it your false break setup? Is it your counter trend trades? And then you also know which are the ones that are causing you to lose money. Then what you need to do is to simply focus on the setups that are making you money and stop trading those setups that are costing you money. Simple. And that's why your trading journal is so powerful. But most traders, why don't they do it? It's hard work, Rayner. It's dry, it's boring, blah, blah, blah. And that's why, again, most traders never succeed. Okay, so quick recap. Number 1, trade from an area of value. Number 2, trade with the trend. Number 3, have a stop loss that makes sense. Number 4, have a target that makes sense. And number 5, have a trading journal. So with that said, I wish you good luck and good trading. I'll talk to you soon.